Good morning, ladies and gentlemen. Well, the risk dial, by my calculation, is at minus 28. So we're definitely in risk off in all time frames. We know what is wrong and we are fixing it. It's going to take another month or so to finish it and to make sure that everything is working perfectly. And then we can add a whole load more instruments for you to watch and be up to date with. I apologize for how long it's taking, but it's better to do it properly and do it once as opposed to constantly having to fix things. So we're migrating everything to Django, and to cut a long story short, it's a big job, but it's going to be much better once it's done. Having said that, we're very much in risk off, as I said, and let's examine what the levels are, because next week is going to be very, very exciting again. Can the charts predict what Putin's going to do? No, but they show you what the market is expecting and how the market might react if it gets that one set of information or another set of information. It's all up to the next headline, but let's examine what the charts are saying and see how they might react. As always, let's start with the yield curve. These are the 2s, 10s. What is the predictive power of the yield curve ahead of these events? Well, very little indeed. There's not a lot that the market can do here. A month to go to the Fed's meeting. What can it possibly say? Not a lot, but how the market is positioned is going to tell us a lot about what the possible reactions are going to be to war news. I would suspect that from now on and until the Fed meeting, we're going to get more or less parallel shifts in the yield curve. The yield curve is going to go up and down in parallel with events and headlines. I don't think there's going to be much movement in the yield curve per se. I think that it's going to be more in terms of what the longer term expectations for the economy are. And that isn't really going to be seen in the yield curve, but it's going to be more seen in the individual tenures. And that can be seen in every single one of the individual parts of the yield curve. 5s, 30s sideways, 10s, 30s sideways, 5s, 10s sideways. I mean, the overall moves on the week are like 1 or 2 basis points. This is a market which is in limbo and a market which is awaiting direction from events. So really nothing to see here. But what there is to see is from the individual tenures where we can have a look. And this is the 5s. As you can see, we are, very much overbought and we are waiting for events. 177 is your swing level. If that goes, we come back down to 161 or potentially even 145. You can see where the area of support is. Why would why would this back up? It would only back up on a flight to safety. There is no other reason. Inflation is accelerating and war is inflationary. Longer term, war is inflationary. Commodity prices tend to spike. Inputs tend to spike in general. So I really can't see any reason why the fires would back up apart from a very violent risk-off mood, which at some stage gets rejected from levels. So to me, these are the levels: 177, 161, 145. From 145, I would love to go short of the 5-year note again, because I think that is the absolute maximum that a risk-off move can achieve in terms of knocking back yields. I still think that the path of least resistance for the 5s and the 2s eventually is to be flat around the 2 to 2.25% level. What has the Fed told us so far? They've told us that they will do quantitative tightening in terms of balance sheet runoff. They have not told us that they will actively sell coupons. That is what they have not told us. Excuse me. And that, to me, is potentially longer term bearish for the yield curve, i.e. that it flattens more. But they have said that they want to raise rates by 1% by July very quickly, and then see what happens and let the balance sheet run off. Well, that to me says that you're going to get a more or less flat yield curve somewhere around the 2% area. And, we're there at the moment, so the risk off can knock us back. But as soon as that disappears, we go back up. In the 10s, that to me says that, again, we are likely to trade around the 230 level at some stage, but the risk off can easily knock us back all the way to 169, 170. Am I saying we're going to see that? I have no idea. I don't know what Putin's going to do, and I don't know how events are going to unfold. But there is a definite risk-off mood in the market, which could knock us all the way back to 169, and then we go again. To me, that is the really, really important level. And I'll be watching it like a hawk. That is the level where I think the risk-off move is going to be exhausted. In the 30s, I wanted to show a daily chart as well. Can we come back all the way to 203, 204? Yes, easily. Okay, easily. Look how quickly we did that there. We did that within 2 weeks. If war breaks out, we could do that in a couple of days. And then I think that risk-off move is going to be exhausted, and then we go higher. Because it just doesn't make sense that bonds will do anything more than a quick risk-off move and then continue on their merry way, because I keep on saying war is long-term inflationary. Nowhere is volatility in the bonds going to be seen as much as in Europe, because after all, this is a war in Europe, and the consequences of that will be mostly felt in Europe. This is the Schatz. We touched right back to where the ECB day was, and can I exclude a move down to minus 57, a spike there? No, I can't. I think that on war news, definitely there is going to be a spike in futures prices in all tenures, but I think this is going to be a wonderful spot to get very short of all German instruments, whether it be the Schatz, the Bobble, or the Bund. So I have my level marked. I have my first level here at minus 49. A lot of people didn't think it could come back, and it has. And here we are at minus 58, and I think that is going to be the very important level. If I change that to a monthly chart for you, you will see what I mean. Can we come back to here? Absolutely. Why not? But then I think the likelihood is that we go and revisit this minus 27 over time. If I change this now to a 5-year, and this is now the monthly chart. Okay, let's change it to the daily so you can understand what is going on a lot better. Can we come back to this minus 12, 11, 12? Absolutely. And can we come back even into this kind of level, minus 27, minus 30? Yes, we can. It all depends how violent the move is and how much flight to safety has to be done. But I think that you're going to have some wonderful opportunities. This minus 31 level, I really don't think that it can break through. Let it spike. I mean, by all means, you don't have to trade every tick. Let them spike. Don't provide liquidity for them, and you will get a better level to sell from. If I change this again to a monthly chart, you can quite easily see, and I go back in time, you know, there is absolutely no reason to believe that you can't get back here and then have a very violent reaction to the upside. And therefore, let it trade, give time. You know, time is on your side when these things happen. Again, don't trade every tick, let it come. And if I change it to the tens, and this is now a monthly chart of the Bund, I would have thought that this level is going to be ideal. This is around the, 8-9 basis points. This kind of level I would love to see. The yield curve definitely will steepen and continue to steepen, i.e. all the action is going to be in the short end, 2s and 5s. People are going to be buying those because they want the flight to safety. Their calculation is going to be the ECB is going to postpone any hikes. It might even provide liquidity, etc., etc., etc. Are they wrong in the short term? Probably not. But I think in the long term, they're very wrong. I think war is inflationary, and actually that will have to speed up the tightening of the ECB. So any kind of retracement to these levels, to me, is going to be a wonderful opportunity to load up, certainly with options. I keep on looking actually at the French chart. And the French chart, as I've told you many times, is actually much cleaner than Bund's and has much more predictive power. Well, this is now a weekly chart, and as you can see, it tends to come back to this 61 area. But that is probably, a very good indicator. If that does not break below 61, that will be a very good indicator that you will actually get the move back up in Schatz, in Bunds, in Bobble, that I'm pretty convinced is going to happen at some stage. So I'll be watching this level in the oats very, very carefully. That's all one can say. The yield curve in Europe should steepen. Again, because the calculation will be that the ECB will do less in time, or that people need the short end as a safety asset. To me, that is short-term right, long-term very stupid. And let's take advantage of the long-term very stupid. The differential between tens and bunds is actually keeping remarkably steady. And that is another chart that is going to give us a clue about which way bund yields are eventually going to go. To me, if we can't, if this war thing, whether it happens or not, cannot break this 181, 182 level, then all the pressure is going to come onto the downside again. And as I keep on telling you, this is a very, very important level. 158, if we break 158, the yield move in Europe is going to be much, much stronger than the yield move in the US. It'll be basically a catch-up trade by the ECB to the Fed. And that is going to be very significant for other assets like the dollar and like gold. But at the moment, naturally, we started that move, as you can see, and this war talk has absolutely stopped it and reversed it. But once it happens and once it's out of the way, if it resumes, it's going to be a very powerful move to the downside. That means that European yields in general will catch up with US yields. How does that make sense? Well, that makes sense because inflation, if it's there, it's a worldwide event. It doesn't start in US and end in US, but it's more or less the same. The commodity prices are the same everywhere, and if commodity prices and energy prices and whatever you want to call them are the same everywhere, the inflationary spike is going to be more or less the same everywhere. And therefore, to me, it would make sense that eventually we get the move through 158. And that, to me, is very, very bearish of European yields. Because I think that US yields are going to be stuck in a relatively small range, much smaller than European yields. If you actually compare the previous chart, which I showed you, and that is the the differential between 10-year US and 10-year Germany, it actually coincides very well with a daily chart of the dollar, of the DXY. And as I keep on saying, if we can't break, even with war talk, if we can't break through this 96.47, and especially if we can't break through 98.54 on the upside, then the pressure will return, I think, to the downside. In the meantime, we're stuck, aren't we? I mean, with all the talk, with all the headlines, we went nowhere last week. I think the danger is that, renewed war talk takes the dollar up to 96.47, but its behavior there is going to be very, very interesting. If we can't break, and that is what the chart of the differentials would say, i.e. we only go to 180, 182 differential between bunds and 10-year notes, and we can't break up here in the dollar, then the pressure, I think, will revert to the downside, and that will be your signal to sell dollars. One thing at a time, one headline at a time. I will naturally tweet it when I see it. Gold, well, what to say? It was almost inevitable that the market would get the bit between its teeth and try the upside. Every headline is more terrifying than the next. We are almost discounting an apocalypse. And the fact that, I will show you later, the fact that gold has actually gained against everything, against equities, against bonds. Basically, it's the flight to safety asset that's been, that the market has gone to. Again, to me, it's still a trading asset. This 1912 level is going to be, you can see the highs here, 1912, 1915, is going to be very, very interesting. Look what happened the last time we were up here, and this is this move down to 1764 in a week. Okay, so if this situation is resolved in a week, 2 weeks, and thousands of people don't die and things like that, you will get this move back all the way down to certainly 1830 and quite possibly 1764. Why? Because bond yields will no longer have the support that they're having at the moment. German rates would definitely go up a lot. And the yield curve in Germany would flatten, and probably the yield curve in the US would steepen, because the short end is now just going to await what happens with the Fed in a month's time. So to me, it would make sense that on a move, on a risk on move, because the conflict's been solved, you get a move all the way back to at least 1830 and quite possibly 1764, where I think it's a huge buy again. But, you know, what can one say? That is all the charts are telling you, and that is all the macro is telling you. It's the next headline and what Putin decides to do. What happens if if actually there is war? Well, the spike level is 1958, 1959, 1960. That is the level that you are more likely than not to trade, however overbought this is. And, you know, you pays your money, you takes your choice. You think there's war, 1960. You think there is no war, it's asymmetric. We'll definitely go to 1830 and quite possibly 1764. Look at this: 1, 2, 3, 4, 5, 6, 7, 8 days. Within 2 trading weeks, it was from the very highs to the very lows. And, you know, here and here. Could we get a repeat? Absolutely. You know, there is absolutely no reason to think that that wouldn't happen again. This chart is actually very interesting. This is gold against TLT, and this is the all world stocks against gold. We are back at levels that we were in 2012, 2013, and here in levels that we were in basically 2015, 2016. So gold is now at one of the best levels against bonds, and this one actually makes sense because of the inflationary environment. And this one makes a little less sense because I think, you know, in the longer term you get very much more money from equities than you do from gold. But it just shows you the size of the moves that we had. This level is actually great support for equities. That to me says that equities are unlikely to fall apart. And we are back at a very, you know, at a weekly long-term moving average. Says to me that equities and gold are very much going to move here in a relative parity move, that i.e. that gold is not going to outperform equities by very much, even if there is a war, and that these spikes are going to be, you know, if there are some spikes down, they're going to be retraced. So I really wouldn't recommend selling equities and buying gold at this level. But this chart is much more convincing longer term that gold will continue to outperform bonds, and that is what makes me quite bearish of bonds for the long term. You know, not something that's going to happen next week or next month, but something that's going to happen and continue happening over time, over the years. This is gold against copper, which, you know, has some predictive power. When gold started outperforming copper, we had the big move in bond yields. And now it's, you know, in no man's land. But I'll be watching this over the course of the next couple of months, and I will show you where it's going. Basically, what I would like to see is a failure here, and copper starts to outperform again, gold again, and that will be an indicator that the economy is fine. You know, at the moment, what can you say? It's basically traded in this range for such a long time. This is a bit of a risk-off move, but this is going to be a leading indicator at some stage again. And I will keep on tweeting this and following it over the next few weeks, because I think it's going to be very, very interesting what it does from now on. Before I move on to DBC itself, I think it's interesting to have a look at SPY DBC. So this is obviously the long-term trend that equities outperform. You know, this is a daily chart, but it goes all the way back to 2012. And we have a very long-term ascending channel. which we broke, and now we are back to towards the bottom of the channel with very, very good support where we traded for, best part of 3 years really. And we're not a million miles away from it, right? It this to me says that at some stage, very close to where we are now, maybe not in time, but quite possibly in price, you want to get rid of DBC and actually get back into equities. That's what the risk reward says. Can we get a spike through the lows? Yes, sure, like we got here, a spike through the highs. But I think that is a very clear ascending channel, and the channel makes sense. Over time, human innovation has to beat, digging things out of the ground. And therefore, this chart to me is quite interesting. It might take a long time, but this is one which I will now, report to you on a consistent basis, because I think the longer term opportunity is certainly there to start selling DBC, lowering that asset allocation, and at some stage increasing equities. It's very interesting, really, that all these cross-asset charts are coming into place as we go for this war that is going to be so disruptive potentially to commodity prices, longer term commodity prices. Is there any real change in the chart? Gold, DBC? No, not really. We're still in a downtrend. We're still headed towards that 638 level, which I think longer term is going to be a great signal that the commodity boom is over. And if we look at the weekly DBC chart, well, we're up, 9 weeks on the trot, and every week it's a little bit weaker, isn't it? I mean, the uptrend, it's certainly running out of steam. And where are we running out of steam? We're running out of steam at the 100% projection, and we're running out of steam as we approach this 24, 38, 39 level, which marks the difference between the trading ranges that we had in 2011 to 2015, before we had the great deflationary bust, and now we are returning to them. I think DBC is definitely running out of steam, and all those cross-asset charts are saying the same thing. To me, the charts are actually saying that this isn't going to be a huge inflationary event, and not to overplay that card. So this is it. To me, this, if we get there, that is going to mark the top for quite some time in DBC. But we can also look at oil, and more or less, that coincides with that 97 level. It's quite interesting that this week, with all the headlines, we just could not make headway. That's got to tell you something. It's got to tell you that the risk reward actually is going to be down towards 75 rather than higher than 97. Again, another indicator that really there isn't going to be this huge inflationary spike and this huge war, which at some stage favors a move back to risk on. We should really look at equities in terms of event at this moment, where we're not trading yield, we're not trading anything, we're trading event risk. And the most interesting thing that I can see that happened last week, or the really weird one, is that actually volatility went nowhere, actually closed down on the week. Okay, we are at this very important 30% level. That is a very, very important swing level. So that does that tell you something? I don't know. Maybe the market is already hedged. Maybe a lot of people hedged their risk in the past several weeks, 1, 2, 3, or 4 weeks when the first speculation about a Russian invasion of Ukraine took place, and now we are just basically marking time until it happens. It's quite possible. Where would it go on an event? Well, the spike would probably be to something like this, mid 40s. Yes, makes sense. As you can see, all these levels, this is the kind of level where you would go to on a really bad event spike. But that's probably where you sell it, right? 44, 45. And you sell it for a move back down, unless the event is horrendous and has some very longer term implications. But that is what the chart is telling you. Do I know what Putin's going to do? I have no idea. But that is what I'm looking for if there's a headline. You have to be prepared both ways. If there's a headline that something, that the invasion started, and you get headlines about thousands of dead and God knows what, you're looking for this spike to at least the mid 40s, and there you can sell it. So now you can calculate your risk reward. If you think it's going to happen, well, the risk reward is pretty good. You're buying 28s to sell 45s, and if you're wrong, well, it'll go back down into the very low 20s. Or 20, but it's not going lower than 18, 17, not for a long time. And therefore you calculate your odds and your risk reward, and you know how to play this. As simple as that. And it's also very unusual that so little happened in Europe last week. Stocks and DAX both hovering around the very, very important levels that are unchanged. We tried the 41 level, rejected it, bang, straight down. To me, 39.86, 38.44 are the absolute levels. Whichever way you calculate targets, you get something in that region. And in DAX, the levels are very clear. 14,760 has been the rejection level, for what is it, since April last year, so just about 12 months, okay? If we break through there's nothing until 14,000 and 14,072, 14,001, the 100% projection is here at 14,280. So those are your ideas on an invasion news. I would expect this to break and have a very sharp breakdown towards this 38.44 area, and then a move back up to 41.41. Ties in with the gold against equities chart, ties in with the fact that commodities would peak. So that would be, to me, the flush down that refreshes for later on. I just don't think that equities are going to break too hard, because I think that an invasion, if it happens, is going to be limited, quick, and a solution, a settlement will be found quite quickly. I don't think anybody has the stomach for a long-term war. I don't think Russia has the stomach for it, and I don't think Ukraine has the stomach for it. Nor is it in the interest of any European country. And I think that the de-escalation eventually happens, and therefore you're talking about a move down to these levels to move right back up. And here we have my clean chart of SPX, and I think you can see how 42.55, I believe, would be a gift. Anything 42.55 to 41.28, I think, is going to be a gift. And I'll show you next why I think it's going to be a gift. And here we have it. Basically, those levels are going to be times 18 multiples. So we will have discounted every possible increase in bond yields, and we will have discounted just about everything. While these are rising, while these expectations of forward earnings continue to rise, I think that there is very little odds that we can stay below that times 18 level. And that would be, 4,100, 4,200. To me, that becomes a gift for a move back up towards the times 20, which would be, guess what? Scene of the crime, 45.35 is my guess. And on a weekly XPX chart, that's precisely what I'm seeing. Here we have the 41.98 level as 236 of the retracement of the whole move from the lows. That would make some sense to me, that we take out the stops here and then come back. I think that by the time the Fed meeting comes around on March the 16th, we are going to be far closer to this red line, to this moving average, than we are than not. We are unlikely to be in it, through the lower Bollinger Bands, which are right here at 43.20 on the weekly, and they're going to go down very, very slow. We only have 3-4 weeks to go, so another 3-4 bars here. This is now coming down. We're in risk off, but I think that these lower levels are going to get bought, and we are going to be trading this kind of a range until the Fed comes along, which makes sense, because it's all about monetary policy, or it's all about macro. These events come and go, and once they've come, they're that much nearer to going away. Naturally, we're in a headline-driven market, but I would have thought a move down is going to get bought, and going to get bought heavily, because of the previous chart of the Blue Angels, but also because we will be very, very oversold ahead of a market which will like to be much closer to that red moving average by the time the Fed comes along. The Nasdaq is actually the weakest market, and the one where most risk is being taken out of. People are definitely getting out of high beta stocks, and how much sense does that make at the moment at these prices? It still makes some sense. There is still a possibility that we actually come down and trade somewhere around the 13,400 level. To me, 13,816 is actually the key. Below there, we definitely trade 13,400, and we could easily even trade 13,100. The Nasdaq tends to have much more Momo than the SPX. And if the SPX takes out the lows and gives you a great buying opportunity, this is actually going to go much further and give you an even greater buying opportunity. So what I'm saying is that don't be surprised to see the Nasdaq continue to underperform the SPX and give you better levels. It's quite likely. Now, where do I think we will be in 1 month's time? In a month's time, I think we will be higher than this close. Again, as I say, events come and go, and once they're gone, you go back to moving averages. I would have thought that by the time the Fed comes round, we might be closer to the middle of this range here, somewhere around these levels, 15, what's that, 14,500, 600, rather than down here. I think that spike down should be bought for a move back up to these kind of levels, still below the moving averages and still ready to come back down again once the monetary policy of the Fed becomes much clearer. In a headline market, it's even more important to trade levels. I've updated all the levels. This is particularly what I'll be looking at, this sector here, to give me clues about the dollar and about bonds in general, but equities too. I still think that the equities are a buy at those spike levels down, which I showed you, and I've updated the chart. Certainly, this is where you start and I think that by the time the Fed comes around, we're definitely higher than those levels. It's going to be played by ear, played day to day, update these levels, and I will do that every day for you next week, and we will see where we are. The macro situation and the shape of the Blue Angels, the ascending slope of them, says that lower multiples are definitely buys. It just doesn't make sense that they're not. Every single level has been updated for you, and I will naturally post this and change it as needs be every day next week. Thank you very much indeed. Have a lovely President's Day, and tweet you on Tuesday, if not on Monday. I will be taking a small break on Monday, but I will still have my computer with me, and therefore if anything happens, I will be ready to tweet to you.